This video is going to explain to you how you would calculate cost of sales in order to be able to use it in the statement of income, which is very important when you're trying to work out the profit that your business has made for the period in question. The first thing that we're going to look at is the effect of inventory on our gross profit. So far what you've done is you've simply recorded all the inventory bought as an expense at the time that it was bought. This makes a lot of sense, as if you buy stock, you would expect and certainly hope to sell it in the very near future. And obviously the cost of that stock has to be offset against the sales or the income that you earn in order to determine your profit. However, what you need to realize is that at the end of the year, if you have got some inventory that has not yet been sold, firstly, this inventory must actually be considered an asset. It's a current asset because you do still have it available to sell in the following year. It will still be there to generate an income, and it has not actually been sold as yet, and so the expense has not yet been incurred. So while adding it as a current asset, you also want to reduce your cost of sales expense because you have not yet incurred it. This means that when you are calculating your cost of sales for the purpose of the statement of income, you would need to calculate it by taking your opening inventory or whatever you started the year with. This would be a beginning balance. It would actually be whatever your inventory on hand was at the end of last year. To that, you will add all the purchases or the stuff that you bought, all the expenses for this year. But lastly, you would need to remove the closing inventory or the inventory on hand at the end of this financial year, because quite simply, you have not yet sold that stock and it is actually yours. It is a current asset. It is not yet an expense. In the statement of financial position, you will then show this closing inventory as a current asset for inventory on hand. The vertical format of the statement of income is used in order to make it easier for people who are not accountants to understand. If you give somebody who's not an accountant a T account, which is how they used to do it in the old days, people would very often get quite confused. But if you look at it in the vertical format, it's much more logical and people can understand it more easily. It also allows for multiple columns for comparison so that you can see how you did this year and immediately at the same time compare it to the same relevant figures from last year. So this is what your statement would actually look like usually. You can see that at the top here, which is the important part that we're looking at now, are all of our trading activities, specifically our revenue or our total sales income. Subtract your cost of sales, including your calculation for the closing inventory that we've just looked at, and that will then give you your gross profit for the period. You can then compare it to how you did this year versus how you did last year, and you can see if it's increased or decreased, maybe your markups have changed, etc. Below that, you would then show all your other operating activities. In other words, the day-to-day incomes and expenses of your business. Firstly, income from any other services rendered which you may have in addition to your trading activities or buying and selling the goods. You would add any other operating income and subtract all your operating expenses to get your operating profit. Operating profit simply means the profit that you've earned or managed to achieve as a result of running the business day to day. Lastly, you would have kept your investing and financing activities separate. In other words, your interest income and your interest expense. This is simply because they are not income and expenses from the day-to-day running the business, but simply a result of your investing and financing the decisions that you have made. So it's quite useful to keep that separate so that you can see, are you clever in the way that you're investing and financing in your business compared to the actual day-to-day running of the operations. You can then add all of those together to get your bottom line or the net profit or loss for this particular period. So that is what your statement of income is going to look like. And you'll remember that we did a little calculation for that cost of sales incorporating inventory. I want you to think for a minute. What happens if you had to pay for the stock to be transported to your business? Surely that will also affect that cost of sales? Yes, it will. So carriage inwards, or the delivery cost to get stock to your business, must be included in that cost of sales calculation also. Because the more it costs to get the goods to you, the less gross profit you are actually going to make. So therefore, we can show our costs of sales with including our inventory calculations and our carriage calculations. And we can also show how we worked out our total revenue as part of the statement of income, if you just stretch it. The green amounts, revenue, cost of sales, gross profit, may well be simply shown on their own, but for management purposes, it can be useful to open them up and show these calculations. Obviously, for revenue, it's simply your sales minus your sales returns from customers. And then your cost of sales is going to be your opening inventory plus purchases, as we looked at earlier, plus your carriage inwards. You would then also subtract any purchases returns and your closing inventory to get the total cost of sales. You can then take your revenue minus cost of sales to get the gross profit. So that is how we